Hi, everyone. Let's have a great week. How are my trading warrior brothers and sisters doing? That's right, sisters too. Hi, Mary, Michael, Simon, Mike, David Hess. How are you? Shahab. Okay, so central banks extravaganza this week. I don't know about you guys, but I'm thinking about, you know, not trading each individual currency until after their individual central bank decisions and pressers are done. So, good morning, team.
Morning,
How are
Dale.
you? Dollar starting
Morning.
morning, morning. So,
Good weekend.
dollar's starting off a little weaker. Yen trying to make progress. It's slow, quiet. Still needs 131, and then after the inflation news Friday, the 10-year sold off, but it's above the neckline now. If I extend it out, if I use it at an angle, I remember when I read Edwards and McGee, they liked Head and Shoulders neck. They liked necklines that had kind of a declining feature to them on Head and Shoulders bottoms and an ascending feature to them when they were Head and Shoulders tops. So this is pretty classic textbook Edwards and McGee. You know, I think that sometimes you have to wait for two closes for a breakout to confirm it, but this looks like it's trying, and the same thing is happening in yen. They're almost identical patterns, right? So um, it looks higher to me in yields. The yield chart looks more convincing to me than the yen chart. And what are your thoughts? Euro strength, ECB. Which days, Ryan, are each individual central bank's meetings? For example, we
Fed's
have,
first, Fed's first on Wednesday. Then
okay,
it's the Bank of England. Then the ECB on Thursday.
okay, they're both on Thursday.
Yeah, and
Okay,
then NFC on Friday.
yeah, so um, the Aussie already had their central bank meeting. Is that
Yeah,
correct?
that's
Okay,
right.
so and Canada.
Yeah,
So, I think that they might in some way be better to trade because they're not going to have any surprises. They may decline or rally in sympathy with some of the other action in the dollar
yeah.
and euro and pound, but it's already out there. So I was looking at CAD. I'm not sure about levels, but a couple of outside forces have me thinking about it. I wasn't expecting this type of opening with risk off. Any news behind the risk off move and stock markets around the world?
No, not really. I think it's just a bit of
Profit taking?
profit taking. No one wants to push the boat out too far. If you got a nice rally to 41, everyone was waiting at 41 to sell it. They sold it. No one
Yeah.
else is coming in and saying we want to take it further than 4100. I think we're going to see a bit of ping pong between the short term ranges at the moment. But talking to central banks, just to look a week after, we've got the Bank of Japan again the next week. I think
Okay.
it's the next week. So you're out of one into the other, but a hell of a lot of data this week. Tons of data this week. We've got ISM, both ISMs. Sorry, Bank of Japan's 10th of March. Sorry, I read it as Feb. We got ISMs, we got ADP, jobless claims, lots of job stuff, GDP from Europe, PMIs later from Europe, and non-farm payrolls. It's a huge, huge week. And that's a good thing about it. That's why we love trading for weeks like this. We get a Fed, they might make a move and be more hawkish, and then on Friday we get a minus 200k NFP, and everyone goes the other way again. It's
Yeah.
it's going to be
So
good.
WTI put in a pretty negative day and starting off with a pretty negative week. I know we never took out the highs, but perhaps a triple top here. And then when you look at the weekly, it was really kind of a puny rally. Looks better on daily and shorter term charts, but this was kind of a lousy rally. And I think there are a lot of people pretty bullish. And to me, it looks like, you know, we could have another shot down. That's something that, you know, I don't think central banks' decisions are going to affect. So if I'm right about crude and we're getting risk off, you would think that long side of Canada and short side of Aussie will work at some point.
Yeah.
What that, you know, that's what's in my head right now. Just, you know, looking for spots and trading those and trading WTI.
Well, I'm long a bit of WTI. I just bought the dip on Friday,
Okay.
80.15. But looking at your daily chart, I don't know if I want to be long anymore because that daily chart.
I'll show you a better time frame for you. What's what's the
ration? Pick one to my book. Make it look better.
Okay, here's the ones that you like. The 15-minute chart. But even this, you know, I don't know. Anyway, I can't find a time frame. So tell me why. Give me the whys behind your bullishness here. Come on.
No,
fundamental.
I fancy catching a knife.
Okay.
Pretty much.
Right.
You know, you pointed out that that was quite a big move on Friday. You know, $3 we came down pretty much on Friday.
Yeah, that was a bad candle.
On not a lot. And I just thought, oh, okay, I'll stick a little stick a couple of fingers out and see what happens.
Well, you know, we could bounce to, you know, I was lucky. You know, I did it Friday. I did it Thursday and got knocked out after taking partials, but it could rally back to 81 and still be bad. That would kind of be my line in the sand. So another gap up in VIX. You know how many times it's done this? Let's see. It did it here. It did it here. It did it here. And then all of them, you know, were just, you know, almost like manipulated up so they could sell into it. I don't know. Is it different this time? I know Blake brought up VIX DSI last week being single digits or 10. So, you know, that's something to think about. You know, I've talked to VIX people and most people are, you know, still selling volatility, even though vol is pretty cheap here. So we'll see if this gap gets filled. See, did it again here.
Are those the weekly opens? Are they when it? Yeah.
No, I don't know if they're weeklies, because this was on a Tuesday, so that wouldn't be a week, like a Monday.
Well, yeah, because it was Martin Luther King Day last week, wasn't it?
Okay. This day.
Friday.
Yeah, Monday. Christmas. Yeah, so the good, you know, Friday. I don't think there was a holiday here early December. So I don't know. What difference would it make? You would think that after holiday, they could just goose it, and because there's a little more fear coming into the market, especially with the 38 handle drop in S&Ps.
Yeah, you know, the VIX is something. If you get a bit of weekend news, whatever it is, can that's why you get a different open sometimes. You know, it's not that prevalent in other pairs or other assets, but the VIX, you know what the VIX is like. If you get a stinky headline at the weekend, you get a move in the VIX.
And the metals, still silver outperforming today. Here's your gold silver ratio heading down. Maybe this was a failing rally.
Yeah, it's still in the middle of the range though.
Yeah,
it's going firmly sideways. And as I said on Flow Show this morning, I'm not 100% convinced on which level is going to get hit first. Is it going to be a breakout above 2450, or is it going to be, you know, 2190 to 2220? I don't know. So I'm holding my horses because, you know, the Fed is expected to do 25 this week. I think there's no doubt about it. And the market's expecting one more 25 after that. And that's kind of fair. Excuse me. But the question is, will Powell continue trying to talk the hawkish talk? There's a good chance of that. And if he does that, then markets are not going to like it. So that's the risk for being long silver or long risk in general. I still think that going up to the FOMC this week, the pain trade is to be short. equities, S&P and all that. So that's why I think, yes, we're down today, but I've been saying this for a few days now, where we have been creeping up, and yes, we're down some, 0.75 percentage point today, but I still think the path of least resistance is to go higher into the Fed. After that, obviously, all bets are off. But I think the Fed is looking for reasons to get away from the hawkish rhetoric, and CPI has been dropping at a decent pace. I've said many times, I think this month's, February's print is going to be very, very important, and I think it's probably going to disappoint. It's going to come lower than expectations, and that will give, I think, the Fed more ammunition to halt and then see what happens. Do I think they're going to be cutting rates as quickly as the market predicts? Probably not. But we need to take it one step at a time, because we really don't know what's going to happen in a couple of weeks' time, let alone in 6 months' time, because the data that we're getting is quite volatile. It's not the case anymore where inflation was at 2% and a 0.1 or a 0.2 shift was a big deal. We are getting big prints and quite volatile numbers, so we have to wait and see if we get a trend. And we are getting, at the moment, at least in the US, a trend going lower in CPI. I've been talking about this for months, that I think late Q1 of this year, we're going to see this trend gather speed. And
so how do you square your inflation outlook with your view of looking for higher rates?
Looking for high, I'm saying I think that they're going to be on pause for longer than the market expects.
Oh, I thought you were looking. I thought last week I heard you say that rates have bottomed. Going higher.
I think in the medium term they are. I'm not talking about a week or two or a month from now. I think that theoretically, all else being equal, yields are. I think they've gone a bit too far in pricing what they're pricing. This is what I mean when I say I think.
Well, why did they go too far if the inflation data is confirming that they should fall?
Well, inflation data is confirming that it's coming lower. I'm just saying, and I've said this before, I think inflation rate is going to drop, but then it's going to start grinding higher again. And the reason why it's dropping, I think it's just simply on the way it's being calculated. It's tough trying to forecast, right? Inflation for 6 months from now. I don't think anybody can do that. We make our best guess. But I think overall, the 10-year US yield at 350 is pricing a lot in terms of where rates are going. Because remember, we're going to be above the core PCE year on year. When they hike rates now, we're going above that, and we had 4.4% last week's print. We're going to be going above that. So it's difficult. In my opinion, it's difficult to see the Fed going this quickly to a pause and then to cuts. That's what I'm saying, and that's why I think the market's going to slowly start repricing yields a little bit higher. I mean, the back end of the curve. I mean, not the short end. So 10 years out.
Okay.
Anyway, it's a difficult one. I'm not saying I know what's going to happen. I try to take my best guess at what I think is going to
deals are sure trying. I mean, they're already up 20 bips from the low on the 19th.
Yep, that's true.
So, yeah.
We did mention that there was some pretty good support confluence there at 330 something, and we have bounced from there. It's been a relatively weak bounce so far, but we wait for Wednesday to see what the Fed gives us.
So hey guys, good morning. How's everybody doing?
Hey, Big.
Hello.
Hey,
my mouth isn't working.
What's that?
My mouth isn't working.
Your mouth isn't working this morning? Okay, well, let me ask you guys this, and I want to say welcome everybody. Happy Monday to you. This is going to be a big week. I mean, let's face it. This is going to be like probably the biggest week of 2023 yet. Just kidding. I mean, it actually isn't. I'm not joking, but this is actually a really big week, right? I mean, we got a lot of central banks. We got a lot of central banks that are pivoting. So when you're talking about like the yields, and I think that yields are moving higher. Let's talk about like what would produce, and I want to ask you guys this: what would produce a continued rally in like the 10 and 30-year yields? I mean, what would produce that this week? If we walk away, excuse me, if we walk away from Wednesday following the Fed, and we feel that the Fed is going to be, well, they were A, hawkish, or B, maybe they made a policy decision that maybe was more unexpected from the markets. Is that what would create this move, a move higher in yields this week? So that's my first question. What do you say, Ryan?
There's not many circumstances I can see a sustained rally in yields. The Fed have got to, unless the Fed really stamp their authority down on how high rates are going and how long they're going to stay there. Even then, I don't see things like 10s holding on to gains. I'd be very surprised if we see 4% in yields anytime soon. Even getting up to that 390 is a struggle. There'd have to be some real big significant change somewhere to bring that yields coming up. Because we're still waiting for the jobs market to tip over. We're playing this soft landing, hard landing. It's looking softish at the moment. I just can't see a way where yields go much higher that they haven't done that already.
How about you, Stelios? What do you think there?
Well, it depends. What time horizon are we talking about? Do you think you're saying for this week, what's going to cause?
Yeah, for this week. I'm talking this week. What's the Fed going to say that can make yields go higher this week?
I think the Fed can easily give us a message where 25 is done this week and more than 25 coming, that they're not going to be stopping as quickly as the market's pricing. It's actually quite good that the market has this very precise thing that it's pricing. It's pricing this week and another 25 and that's it. And then, okay, we go to year end and they're cutting there, but that's far in the future. No, I'm not going to talk about that. So for this week, all Powell has to say is that yes, we do 25, but we really need to see a lot more evidence, and we need to, the wording that he can use.
He could very easily say we have not seen enough evidence yet to suggest that we're ready to they're slowing down the pace of rate hikes, but it doesn't mean they've stopped. And I think that's the message that they got to get across this week. And I think that's the message they're going to get across this week. It was interesting to watch price action on Friday. You saw stocks ripping into month end. We got this reversal, this reversal that we saw in the S&P happened within 2 minutes of the market closing. We saw this this sell off. That was just a short squeeze. I had a buddy of mine who trades. He's my buddy that got me into trading. He's gotten out of the business 10 years ago because he had an opportunity to run a company, and so he's been off on other ventures since then. But he still texts me all the time, and he's still a really good trader. But he bought Tesla puts on Friday, and he thought he would step in front of this train, and I'm like, go, man, good luck. You're gonna do that on a Friday afternoon? He's like, I know. Next thing you know, he's just he's just complaining to me all day. Friday afternoon as the market was ripping, I'm like, I can guarantee you this. And as I was texting him, I'm like, this market's going to give it all back on Monday. This is all low liquidity spiking into Friday. It's a trend day. Fridays are typically trend days. No one wants to get in the way. Who's going to get in the way? Who's going to step in front of that, train on a Friday? And of course the market gets its bearings, and we're back down again here. But the fact of the matter is it, when you see those types of moves when the market is extremely illiquid, you have to be careful standing in front of them, and I see it happen all the time, which is kind of crazy to me. Anyway, let's take a step back and look at some of these currencies. And, I'd love to get your opinions here, since we are seeing the euro just kind of channeling up against this resistance. You can see how we pivoted off of support once again, this channel support today. What are you going to do with the euro here? What's your plan of action? Let's start with you, Ryan. What's your plan of action in the euro? Because I personally think we're up against resistance, but it's, you know, too early to be on the short side of the euro. I tried it last week, didn't work. What are you thinking here?
Play the edges. You know, unless you're taking a definitive side going over the central banks, which is dangerous if you're not in a position, then, you know, if you're short-term playing, just play the edges. You know, you want to be really tight with it. If you're going to short the euro, you need to be shorting, you know, from 109.20s, that sort of area. You don't want to be shorting here at 109 and, you know, it waffles around between 109.30 and 109.90 sort of thing. So pick your edges. You know, you got definitive support down into 108.30, 108. Wait for that. If you don't get a trade, don't trade. But don't get caught in the middle, getting bored, trying to nick some pips before the Fed, and, you know, you get yourself in a mess. Either trade where you're happy to trade and where your risk is defined, or don't trade at all.
What do you think, Stelios? What do you think with the euro here? I mean, you know, we've had substantial gains. You guys have been, you know, calling this since last year about this reversal we'd see in the euro. We got it. Now what do you do? Now what?
Well, Ryan nicely copied what I said on the Flow Show this morning. I'm kidding. We have the same view. So what do I think? Yes, we've been talking about the central bank divergence. DCB more hawkish, so being long euro makes a lot of sense, or has made a lot of sense. Now going into the Fed,
doesn't make sense here.
Doesn't make sense here. Well, that's the question. I think that exactly as I said on the Flow Show, I think if you want to be short, you have to wait until 109.20, 109.30, and then you know exactly where you're wrong. Because, you know, you take out those highs, which is also a 50% fib at 109.33, I think, or something like that.
42.
Okay, wherever that is for you. Yep. And you know where you're wrong, and you cut and you move on. But I wouldn't take this over the Fed, because over the Fed, of course, the market can gap and basically blow you out. So I think if you want to be short, I don't think it's a bad idea actually to be playing the short up there, because exactly you know where you're wrong, and it's a pretty tight. Stop.
Yeah.
But as Ryan said, if you're not sure, just don't trade. If it doesn't get to your levels, don't trade. The problem I have with being short euro dollar is that I think that stocks are probably going to inch higher into the Fed, and that and that's going to push the euro dollar higher, right? Theoretically, stocks up, dollar down. So that's my worry, that I think I'm more certain, let's say, I don't like to use that word, but I think it's a more likely scenario that stocks are going to edge higher into the Fed rather than the euro dollar going lower.
But we've edged higher quite a bit. I mean,
yep.
You know, so do you think we still go higher from where we're currently at? Like, let's say, let me ask you, between today and Wednesday,
yes,
we trade at 40.40. So ahead of the Fed, are we going to be above this level or below this level? What do you think?
Ahead of the Fed, I think we're going to be above. I think we're going to hit, I said this on Friday, and we almost got there on Friday. I think 4,100 is coming, and maybe even 4,150 ahead of it. It seems to be the pain trade. I don't think there's any logic to it, but it's a pain trade. That's what I think.
Yeah, that makes sense. Dale, you have any thoughts here? I know your mouth isn't working, but let's hear you.
Yeah, I really don't have a view until after central bank action. To me, they're coin tosses.
Okay, all right.
Both cable and euro. I'd focus on pretty negative WTI, so I'd be looking for longs in USD CAD, and the commodity currencies may come under pressure with weaker crude and maybe a weaker S&P if that happens.
You know, the interesting thing about crude is it had this inverted head. It still has this inverted head and shoulder pattern, but the thing is it's not playing out to the upside just yet. Yeah. All right. So I want to point out something that, you know, if in the ForexAnalytix community, by the way, if you guys watch the week ahead video, you might have noticed, or you might have heard that we were taking down our pricing. Our pricing has been removed and is back to normal. So if you guys didn't take advantage of it, you could always email support. We'll see what we can do for you. But our pricing has gone back to our normal pricing. FYI. But if you're in the chat room, I'm going to show you how it benefits, because this is the trades room here. Remember, we got a lot of different chat rooms, general chat room. Some people that trade just indices might be over here. You got, like I said, trades room, general chat room, news and research, Spanish chat room, whatever. You'll notice that I'm actually trading less dollar pairs and more crosses right now, and you're gonna see that as a common theme for me this week, because we're in Fed week. We're in Fed week. I don't want to have dollar exposure really, and I'm paring back my dollar exposure as we go into Fed week, and I do plan on trading some of these crosses. And the Aussie Kiwi has been one that really. We had a 200-day moving average, 127% extension. It was a big reversal confluence. You can see this. And then also the 50% retracement, a big reversal. I'm doing things like that ahead of the Fed to keep myself busy and focus elsewhere. So Stelios, where are you going to be focusing this week ahead of the Fed? I mean, are you going to be playing the dollar? Or are you going to be playing other things?
It's a good question. I think I'm going to be playing equities more than anything else. Yeah.
Okay.
I tried it late last week, and I got the direction right, but I moved my stop to break even a little bit too early, and I got taken out, and then it just flew without me. So that was annoying. But I think I'm going to try long on the S&P again, just as a quick play. It's a bit unlike me, but I like it the way it's trading going into the Fed.
Going back to the well. All right. I like it. All right. So Ryan, what do you think? I mean, are you going to be, dabbling with the dollar? Are you going to stick with like the euro, sterling, and other like cross rates now? What are your thoughts here?
Well, I'm going to be keeping an eye on dollar yen, obviously. There's good levels in play there that, big areas that I'm looking at.
Apex.
We're in the middle of nowhere. That's where we're at.
Well, we're in the apex. This is a breakout that's just brewing. We're ready to go. And so are yields going to be the mover here? Are yields going to press the dollar yen higher?
Yeah, well, that's what you were saying about, what could shift yields. Well, the Fed can be in more hawkish shift yields. You've got to look, as I say always, these events, look at where the big price risk is. Okay, the market's priced what it sees the economy doing, what it sees the Fed's doing. That's why dollar yen has stopped going down. That's why the dollar has stopped going up, because the markets, the pivoters have done their bit. They're happy with the pricing now. So it's going to take something different to change us either more hawkish or more dovish to get the dollar moving. So if the Fed are hawkish, okay, they're hardly going to say rates are going to go to 8%. So hawkish means stamping down on the, making sure the market knows they're going to stay up for longer. That's going to get you a lift in yields. That's going to get you a lift in the dollar. But that's why I say I doubt it will last. If I get dollar yen up to, 133s, 134s would be a gift. I'm going to be scaling back in more shorts. But conversely, if they are a bit negative or less hawkish and we get a move to 127, I'm going to be waiting there to pick up some separate longs. And keep
the outgoing CEO of Toyota, I forget his name. He's he's getting the nod. One of many people that are going to get the nod for the BOJ seat. So that's it's interesting when we hear all of these nominations coming in. Digging in, trying to figure out exactly what their policy might look like moving forward is going to be pretty fascinating, if you ask me, especially following Kuroda. So I'm sure we're going to get a lot of names coming in moving forward. So the dollar yen is one of them. What else?
Aussie dollar. As you know, I'm managing my longs in that. Want to see a decent break up above the prior highs. A bit of a zone.
This is a big pivot.
Still a key level. I wouldn't be surprised if we saw a break under there and the short termers threw in the towel and we got to move down to 70. If we got down there before the Fed, I might think about looking for, again, heading back into my core position.
All right. Well, I I guess what makes me nervous about the dollar or the Aussie is something we were just pointing out in the here. I'll just take you guys over to the general chat room this morning, and you can see this is a pretty important chart that happened on Friday. Let me go ahead and this is all this morning, guys. I'm sorry, excuse my excuse my voice. Still dealing with whatever I've been dealing with for the last couple of weeks. But look at that breakout in copper. We looked like we are going to break out in copper last week, and then we did a false breakdown or a breakout, excuse me. And that's, to me, is keeping me short the Aussie dollar. Like, I don't really want to be in the Aussie dollar on the short side. I'm not going to hold it all the way into the Fed. I'm short right now, but one of the things that's keeping me short the Aussie is I'm sitting there looking at copper, and that might actually turn lower. That's talking near term. We're obviously not talking long term, which Ryan currently is. So, hey, I want to say thanks, everybody. Thanks, Ryan. Thanks, Stella. We were missing K-Man today. Was hoping K-Man might be here to get his thoughts, but
he's back tomorrow.
Yeah, we'll catch him tomorrow, and you guys will catch him tomorrow on the Flow Show. So if you guys have not figured out that Ryan, K-Man, Stelios, and sometimes Steve, definitely when he's feeling better, are on the Flow Show, excuse me, it's a free show that's in European hours. I would be there if I wasn't sleeping. It wasn't in the middle of the night for me, but make sure you guys log in and take advantage of it. Also, take advantage of the Trader Funding Program. If you haven't checked it out, they are our sponsor today. So make sure you check out the Trader Funding Program so you can access our money and not risk your own money. And if you need access to larger amounts of capital, come check it out, because that's you also get to be involved in the ForexAnalytix community while you're in the Trader Funding Program for a certain period of time. So that's awesome as well. Dale, I'm excited for you to have Bruce here. Bruce,
how excited? How excited?
Is he here?
Yeah.
Yeah. Okay. Guys, I want you guys to stick around for Bruce Frazier. He is, I got introduced to him, through Dale. I really enjoy Bruce's analysis, but one of the things I love about having Bruce here is he loves to look at the Wyckoff and his Wyckoff accumulation distribution patterns. To me, since in currencies we're only dealing with, most of us are only dealing with 20, 30 currencies, depending on what you're able to trade. It's not often that you're going to see these patterns develop in currencies, because there's only so many to choose from. You can obviously find them in equities a lot more frequently, but I love it when I see it set up, because that pattern is probably the most fruitful when you see it develop nicely in big markets like currencies, or in precious metals, or in equities, like the indices. So I'll leave it to Dale and Bruce to talk about it, but you guys all have a great one. Make sure you stick around, and I'll see you all on the Morning Edge in about 45 minutes. All right, thanks, Dale.
Okay, thank you, team. And Bruce, Happy New Year a month later.
Well, thank you much. Gosh, it's great to be here.
Good to have you.
Love hanging with you guys.
What's top of mind, my trading warrior brother?
Well, should I put up my screen?
Sure. Yeah.
I want to use all my time. I always have more than I can talk about. Okay. So, but Dale, Happy New Year, Blake. And, the last time we got together was October 13th. And that was such a perfect time for us to get together. I don't know if that'll be the case this time, but I have a little
turning point.
I have a little nostalgia for you from what we talked about back then. But let's see, this was my slide from then. And can stocks rally in the fourth quarter? So, and now it's, will stocks rally in 2023? But I do have some interest rates. I do have some, a little bit on the currencies. I don't have the deep dive that you all do there, but maybe my perspective, which I believe to be relatively long-term, I think can be good. So
Okay. No doubt about it. Right or
so
wrong, your perspectives are good.
Oh, okay. Well, often wrong, never in doubt. And so here is a slide I put up in the past with you all. And this is the 10-year decennial pattern, thanks to Season X, my friends. And they, we can see here, this is the 0 year of the decade up to the 9th year. This is just averaging all the decades going back to 1897. This is through 2015, but it's not going to be a whole lot different from what we see here if we were to add these most recent years. And so here we can see that in the middle of the 2 years, so in this case 2022, we have a pretty important low that comes after weakness in the first part of the decade. And then from that, off that, sometime in the second half of the year, we get some kind of a launch. And then we have in the 3rd year, you can see generally the first part of the year is quite good. And then we have a stalling action in the 3rd year. The 4th year, which is really important in this case, I'm going to talk a little bit more about that in a second, is the 4th year is an election year. And so, and then the 5th year is, we can see, is quite spectacular. Now, decades can vary from this. The one that is closest is the 80s. The 80s is quite good, but there's family resemblance.
1982 low in August, and that was
exactly, yes.
That was the beginning of 40-year bull market.
And that was my launch into the industry. So I'm completely tainted by my experience post 1982. But nonetheless, this I think is a great roadmap, and we look for the things that are common, and then we also look for the differences as we go through time. And unfortunately, Dale, I've been through 4 of these now, and so but it's a cool tool. So anyway,
all that wisdom, Bruce.
Yeah, right. If I could only remember it.
I remember things like August 1982, but ask me what I did yesterday.
Exactly, yes. And so here we are looking at this recent downtrend, and then of course 2023. This could very well be some kind of a roadmap for us for how the year could go forward. And so what I want to do is just very briefly, I'm going to go quite fast, and then I'm going to give you an idea what I think the decade could look like because of inflation. And so this actually is the little different view of seasonality, same Season X source. This is just midterm election years going back to 1950. So I just took the midterm election years and I looked for 2022 and how it was similar and how it was different. And the key to using a tool like this is to look for the highs and the lows, and then basically the trend. You don't so much look for extent as much as you look for trend and highs and lows. And so here you can see a low in February 22. The low came in March. Then we have a high at the end of March, and this actually came in mid-April, let's say. But then look at right into the end of the quarter. June, we had a very important low, the red line being the actual S&P for 2022, and the low came late June, so very close. And then the high, very good rally into August, and then we had a high in August, and then another low. Now, if you look closely at the blue line makes a lower low below in September, end of September, right before we met, and then June. So we call this in Wyckoff a spring. So a lower low, we can see that this is a range bound condition. I contend the market stopped dropping really in late May and went sideways really and built some kind of a cause from late May on. We had a spring in late September. Well, look what we got. We got a lower low in the S&P in late September into mid-October, right at the end of the quarter. and then a rally into the end of the year. Now, the thing that happened in 2022 is we actually had a December that was somewhat down compared to the seasonality, which rose into the end of the year. I think that had a lot to do with the fact that the mega cap growth names were just being dumped by institutions, and that they were just getting them off their sheets. They were doing window dressing, tax loss selling. All this was going on. But the interesting part was all we got from that, because we had institutional dumping in late September, we actually had some dumping in June, and then we had a higher low. Yes, exactly. So very important. Now let's look at one last thing here is just that these October, November, 2 best months of the year, very good months in the market in last year, and then December was flat. In fact, it had a downward bias, but a higher low. Now this is this year, and this year you can see this is pre-election years. And so in the pre-election year, we can see that January through April, through the first quarter and into the second quarter, the market is up. Well, think back to our decennial pattern. Decennial pattern mid-year flattened out and then stayed flattened out until the end of the year and showed strength. So this yearly seasonality, looking at pre-election years, matches the decennial, which is really interesting, I think. So strengthen into April and then maybe into the end of the second quarter, and then sideways for the second part of the year with strength at the end. Note the 4 first months of the year are the best months of the year, and then after that it gets a little quieter. So very interesting. So I really wanted to show you that. And in fact, this is what we have so far. January has been good, very good. And here we are coming into the end of the month, and this is the best month of the year. Well, this has been a very good month. So anyway, so there we are.
Monster
seasonality.
Month. So as January goes, the rest of the year, Bruce, huh?
Right. And so this could actually be a pretty good year. Remember, we just talked about how we have a Wyckoffean accumulation style structure, just as we had like in 2002, 2003, and 1982. And so this does have an accumulation characteristic. Now, this chart I talked about when we met last time, Dale, and this is the CPI. And the CPI, this is a little controversial, but I put this chart together based on CPI data, and we can see a very large accumulation style structure in inflation and CPI. And I counted it in 2 segments. And so you can see the hinge here, and this hinge resolved itself into this, what we call a catapult wall, which was just a wicked, wicked advance that we all experienced. We're still paying for that at the pump. And the target of that initial yellow target, 8.25 to 1188. And so very significant advance. And we're all worrying about that because interest rates followed. And the Fed was very slow to respond to this. Well, this is what happened since. Now, it's not completely up to date, but I do have a table for you. But look, here's our 8.25 to 1188 target range. We went right up to 9 and then had a very sharp reversal. And now we're actually working our way down into the 6s. And so this is how you, in point and figure, really validate your counts, is when you get a very sharp, immediate reversal off of your count area. And so this larger count could come into play. We can't predict time with point and figure, but we can predict, we try to predict the extent of the move. But look at the extent of the move if the second part comes into play, and it may not. And but 1575 to 1938, which is just wicked. But here we're looking at this area and we're seeing a sharp reversal off of this. And I think the Fed has effectively gotten what they desired, which is to stop the advance. And so we had a great discussion here a few minutes ago. I was listening to you all talk about this, and I really think that now we don't know how the Fed's going to handle this, but here was the June to June number, 9.1, December to December, 6.5 now. But look at these numbers. This is the CPI trajectory for 2022. And look at how we hit 292 in May. Remember, that was the internal low or the beginning of our potential accumulation structure. And then 296. And look at, we basically have just stalled. Inflation has stalled. And now, interestingly, we had a 298 and a 297. But we've actually had a downtick and a downtick into the end of the year. And so I really think that I've been watching these numbers pretty closely, and these are numbers that go into my point and figure chart. And so I really think that we could be have the Fed. I like to say these are the headlines we're going to see in 6 months, and it's no fun to look at the headlines today. Let's figure out what they're going to be 6 months from now. I think one of the headlines is that the Fed comes out 6 months from now and they say, we were right, inflation was transitory. And we see inflation basically stalling in the first, in 2023. And that, I don't know, they'll be very slow to lower interest rates. I'm not predicting that. I think that they
Bruce, is there anything that you could glean from your data that would say we could have a repeat of the 70s where, you know, we had those victory celebrations more than once, that inflation was defeated and then it roared back
Dale,
to a greater magnitude?
You and I are kindred spirits, I have to say. This why I love coming here. Here is the Dow in the 70s, 60s, 70s, 80s. And so I went back and looked at this because you and I both started our careers on the tail end of all this. And my two business partners, Martin Pring and Joe Turner, were started in the 60s. And so this was, I was required to study this period in great detail. This is the CPI here. And I'm just going to put up all this stuff so that we, and you can go to my power charting show to see more on this. But so $100 in 1960 required $328 at the end of 1970 to buy the same basket of goods. I mean, it was really just a nasty period. This down here is the Dow today. Here's the Dow back 60s, 70s. And you can see inflation has a profound impact on stock prices long term. It definitely, low inflation is great for the market, great for growth stocks. The Nifty 50 era occurred in the 60s into the 70s. That was 51 decision stocks that were growth stocks you could buy, put them away, and never think about them. Such stellar stocks that are today like Eastman Kodak. Yeah. And there's a few good ones in there that are still around, 3M, IBM. You know, they're still around, but those were the Nifty 51 decision stocks.
Where could I get a Polaroid camera?
Yes, exactly. Yeah.
Oh, Polaroid. Man, yeah. You didn't have to take it to a lab, you know. Anyway.
Yeah.
All right.
So here we are today. Look at the commonality here, Dale, between this is the COVID low, and I'll just draw a little thing here, COVID low, and a launch. Look at this, 62. This is wow. A number of reasons for this. This is the Cuban Missile Crisis. This is steel prices. All kinds of problems came on that decline. Similar decline in COVID. And then look at this launch here, and look at the family resemblance between then and into 2020. And that was really sort of as we were getting into late stages of the growth stock era. Well, I think we may be looking at something similar because of inflation, because look at the CPI. This is your point, Dale. And that is that you have this very low inflation, and then it starts to heat up. And here's the inflation that we have now, 181. And I just did every 2 years. So here's 470. much faster ramp of inflation this time. And so how does the market cope with that? Well, the Fed initially fought this ramp of inflation back then, and then I think they declared victory, and we had a decline. Yeah. And so they had this big decline. This could be the 2022 low, similar here in 66, and then a rally. And this is the rally into Richard Nixon's first election. And so it goes rallies right up into the election, which is a rematch of the original high. Here we are, we're going to go into 2024, and we're going to have an election year in 24. And who knows what's going to happen? I have no idea. And then here, look at this big rally off the low, and then a reaccumulation structure, classic white coffee and accumulation, and then a thrust up to the prior highs. Maybe we go higher. The one thing I know is this time's going to be different than the last time, but I do think this big wide trading range could be our world for a long time. This is more than a decade. Yeah. And look at the inflation ramp. This is your point, Dale. They declare victory over here, and then it just gets worse and worse and worse. Yeah. And I do have those inflation point figure numbers that count the higher inflation out in the future. And those may, you know, maybe something gets hit 10 years from now. Who knows? But it took Paul Volcker coming in the late in 79-ish to start to slay inflation. So anyway, so that's what I wanted to show you there. I just think that we have the potential for a either trendless, large downtrend. These swings here are huge. And so, but also these are huge. And we have to think like a trader maybe for the next number of years and not think like an investor. And like we could when we had the dot-com era, yes.
Well, and we had the punch bowl. Yeah.
Yeah, right. Well, we
so are you gleaning any targets like at new all-time highs off these lows with your point and figure work? Do you have some price objectives at new highs?
Curious. It's like we talked about this. Geez, it's like you're reading my mind. So here is
I have cameras everywhere,
man. I'm careful what I say and do.
All right.
So here's
I spy on you at stockcharts.com.
Very good.
I lurk.
So here's a redistribution count. I've got a bunch of counts that I could show, but here's essentially here's a distribution count off the highs, and look at how beautiful this came in. Yeah. Beautiful. Here's our May low. Right. I think this was the May low here, and then here is the June low, July rally. And we attempted to trade all these. We had really good signals on this. Talked about some of those when we got together in October. And so now we have a count here, and this count could actually grow larger. We're actually up a little higher right now, but this count takes us. This is 4,800 here.
Yeah.
And so we have a count now that can get us up to minor new highs. And now we can't say how soon that will happen, but looking at the election characteristics, we might very well be able to do that in 2023 into 2024. And yeah, so here's a smaller count. This is this green area. This count actually can be stretched out a little bit, and 4850, which gets us to the high. And then we have this count that gets us a little higher. And then that's roughly where we are now, where that arrow is. And so you can see now, I should end on there's a couple of things that we can do because I know we're going to run out of time. We talk about the dollar and interest rates for a minute. This is the dollar chart that we used when we got together last time. This is October 12th. We got together on the 13th, and we said dollar overbought above this big trend channel. Now you got to remember my time frames can be so long. I love to look at the longer time frames, but I do trade short term. And so here, throw over, overbought, and then here on the daily chart on the right, you can see that there's our buying climax on the daily chart. Now I'm just looking at UUP here. I'm not looking at pairs.
Yeah.
And so here's our test of the high, and then subsequently what happens since. So this is through December 1st, but you can see the big break in the market that came after that buying climax. And then here, after that secondary test, you can see what's happened. We came down and out of the trend channel on the daily. This is a monthly trend, a weekly trend channel. Really, you could say monthly, but this is daily. And then here's the point and figure chart of where we could go. And the last I looked, which was a few days ago, was we touched 2740 UUP. And this is off this initial distributional top on a swing trading chart.
Oh, we already got to that level, 2740.
Yes, and so we're actually slightly below the low. And again, what we would look for is some kind of a sharp reversal back into the range, this range, to confirm. And so we always want to give the trend I mean, this is a wicked downtrend.
Yeah,
I mean, it's quite substantial. So
a lot of velocity.
There's the
there's
the update right there. And then there was some discussion here about interest rates, and that's really interesting. We talked about those last time. And here is the 2-year yield, which I think this is Mr. Gunlatch's view. 2-year yields are really what set policy, not the Fed. The Fed follows the 2-year. And so I look at a lot of 2-year long-term charts and so on. But I just wanted to show you, here's the chart Jan 17. This is the distributional structure, counts down to 395 to 370. And then over here, you can see this chart's remarkable. This is the 20+ year US Treasury ETF. This is the distributional top, TLT, with 152 high back in 21. And this was the count that it gave. And we showed this count actually at the time. And we were around 101 when we looked at this in October. And we said, well, we're getting into the target zone now. And this count, I actually had originally just taken this count here, widened it out a little more. The 91 and the 93 roughly confirm each other. And then, of course, that's exactly where we went. And then over here on the 2-year, I took a smaller count of this area, and it counts to 390. And I think we didn't quite touch 405 yet, but we're in the target zone. So I actually believe, especially with the trajectory of the CPI numbers, and then also with the, let's say, the hitting into this target zone here, that we can get below 4, we can get into the 390s, but that the 2-year is basically telling the Fed that, or is going to tell the Fed, if Mr. Gunlatch is right, that rates have come, rates are falling. The Fed needs to pause their rate hike cycle. Probably they're already, I think, locked into 2 more rate hikes because of the rhetoric. But I think that effectively they're done. And the 2-year, as we can see from this, is already deciding to go down.
Yeah, you see a lot of tweets nowadays, Bruce. Mr. Powell, the market doesn't believe you.
And of course, if we look at the history of these relationships, it seems to always be that way. I've taken this back cycle after cycle, and the 2-year tends to lead down and up. And so
well,
just
on
pay
central
attention
bank days, Bruce, I put up a Johnny Lang tune. It's called Lie to Me.
I love that.
Everything is okay.
Huge
right.
Johnny Lang fan. Yeah, I've seen him a few times. I've seen him in concert, seen him sing it. Yeah. He's great.
So
here,
watch my stream for Lie to Me. All right, go ahead.
And so here you can just see the spike down. Well, look what happened since. I call these my Frankenstein charts because I pasted this in here. This is what happened. Look at this sharp advance up and out of this target zone, confirming that this and this redistribution count are confirming each other. And let me make one last point here. Here we're looking at prices of bonds, declining prices, rising yield. Here we're looking at yields. I know everybody knows that, but just to confirm that that's what we're looking at. So,
Great
and here we are.
presentation.
Am I going to turn into a pumpkin here?
No, I think you're more of a cucumber. And you know what? Once you turn a cucumber into a pickle, it can never be a cucumber again.
Oh
So
God, no turning back.
Yeah. So anyway, we've crossed the Rubicon, and we're talking about things that grow.
I love pickles. So it's like going from a frog to a prince because I love pickles. It's kind of 50-50
You should eat a pickle
on cucumbers.
when you're playing pickleball. So
Yeah,
anyway, gives you an edge.
So last thing, unless you want more, here's just this is my study chart, my notes, and I put them in here. People can follow them. This is when we got together last time, and we had green shoots emerging, which was internal breadth divergences. We had them here. We had them here. We had all kinds of really good divergent characteristics that we traded at the time. Now, but look, we had a really good run off this October low. Here's the S&P, and we're we're slightly above this downtrend line, which I think my hope is it can stay above. And then here, this yellow shaded area is where all the overhead resistance is above the 200, above the downtrend.
Can you come up with anything that could give us a rally to 4,300 and then fail and make new lows?
Yes.
Really? Okay.
Yeah. I'm here for you, Dale. And
there are some people that are talking that narrative.
Let's see if I can find a chart that would, I've got a whole deck of these things, and because I never know where you're going to go. You're hard. You're a hard man to pin down. Well, and
I have that in common with Jack Schwager. He doesn't script his interviews. He says we have conversations.
I've known Jack for almost 40 years. He's a dear friend, dear person. Yeah. So
love the guy. Yeah.
Oh gosh. Well, here I do have a count here. This count has been sort of a working count for me in green. Yeah. And it goes up to 43.25. This is a really important level in my mind, Dale, because this high from August is we need to be able to rally to and through this high at 43.25, even if we then have a more important pullback, because that was what we would call in Wyckoff a sign of strength. And we need to have a sign that the market can overcome this overhead resistance to supply that is above the market here. Yeah. If it can't do that, then we really, I think, are in peril of being able to go back down to possibly through the lows. So I'm watching this like a hawk. And we're very overbought internally in the market, but we're still heading north on divergences and so on. And so that is really kind of the key thing for me is, let's see.
So Bruce, people watching you, okay, there it is. It's RD Wyckoff is your Twitter handle.
Yes, and I really just more write blogs. I put them up at stock charts. And then also I do a video on Fridays. You can watch it anytime on the Stock Charts YouTube channel. So, I talk about this stuff every week.
A veteran with a lot of wisdom in the technical field. You can't go wrong looking at the pictures that Bruce presents.
Dale, it's always so much fun to hang with you, and we're kindred spirits, and you're actually one step ahead of me all the time. So I have to have 80 slides for this talk.
Well, you had everything I didn't know prior I was going to ask you. You had them.
So the last thing I'll leave is, this was then September 29th. I put this chart up actually the last time we talked, and this was sentiment. Extreme fear 14. This had just happened right at the end of the quarter. This is today, January 30th, and you can see now. So the pendulum is always swinging. That's the main thing to take away from here. So trend is up. Look for divergences.
Yin yang and trade the middle.
Yes, and don't lie to me. Listen to Johnny Lang.
Johnny Lang. Well, could he bend him? So Bruce, thank you, my trading warrior brother. Really.
Thank you, Dale.
I have a great time, and we learn from you every time you're here.
It's great to be here. Take care, everyone.
Bruce Fraser, everybody. Have a great day trading. Join the team in 10 minutes for the morning edge, and we'll catch everyone tomorrow for Turnaround Tuesday. Adios. Thanks again, Bruce.
Thank you.